Right now, approximately 13,000 people are sitting on something that is about to permanently change their lives. Not winning the lottery change, not getting a promotion change. The kind of change where you stop checking your bank account nervously and start thinking about what you actually want your life to look like, because the number in that account has made most of the constraints disappear. These are SpaceX employees, people who showed up to work at a rocket company, accepted part of their compensation in equity that for years existed only on paper, and held on to it through a decade and a half of maybe someday, while the company went from nearly bankrupt to the most valuable private company in the history of the planet. In a matter of days, that paper becomes real. SpaceX files under the ticker SPCX on the NASDAQ, and what is being called the largest IPO in history goes live. The question this video is going to answer, in full, with the real numbers, the honest trade-offs, and none of the hype that's been filling your feed, is whether anyone outside that building gets a seat. Whether someone with a normal income and a normal brokerage account can get a meaningful piece of this. And I'll tell you up front, there are 4 specific ways a regular person can participate. 3 of them you've probably heard of in passing. The 4th, the one that's genuinely accessible with $100 and a phone, almost nobody is covering clearly. I'm saving it for last. Stay with me. My name is Daniel. Let's break this down from the beginning. What is actually happening? For the better part of 15 years, SpaceX is going public was the financial world's version of a recurring joke. Elon Musk said repeatedly, consistently, and emphatically that SpaceX would remain private because the company's mission is a multi-decade commitment to reach Mars. And multi-decade missions are incompatible with Wall Street's obsession with 90-day earnings cycles. That position held for a long time. Then, it didn't. As of now, SpaceX has filed its registration documents with the SEC, published its prospectus, and confirmed a listing on the NASDAQ under the ticker SPCX. The roadshow, where the company pitches institutional investors and sets pricing, is wrapping up. The offering price is set at $135 per share. The planned debut is days away. The valuation at which the company is going public, approximately $1.75 trillion. Let's make that number land properly, because at this scale, the human brain tends to glaze over and move on. $1.75 trillion is larger than the entire annual economic output of countries like Australia or Spain. It is a single private company, built around launching rockets, worth more than most nations on Earth. And here's the detail that changes everything for this conversation. SpaceX has reserved approximately 30% of this offering for retail investors. Not hedge funds, not pension giants, not the preferred clients of Goldman Sachs. Regular people with regular brokerage accounts. We will come back to exactly what that means and what it doesn't mean. But first, let's understand who is actually getting rich, because the scale of this wealth event is genuinely difficult to comprehend until you see the specific numbers. Who gets rich and how much? The employees? SpaceX employs somewhere between 13,000 and 18,000 people, a significant portion of whom hold equity in the company, stock options, restricted stock units, various forms of ownership that have been accumulating since they joined. One thing that distinguishes SpaceX from most private companies of its scale, it has run organized tender offers approximately twice per year for years. A tender offer, in plain language, is a structured event where the company or an outside buyer purchases a block of shares from employees and early investors at a set price. It's a mechanism that let people convert paper wealth into actual money without requiring the company to go public. Each of those tender offers corresponded to a new, higher valuation, a marker on the company's growth chart. Here's what that looks like for an actual person. A senior engineer joins in 2013. Options on 10,000 shares, accepted in lieu of a higher salary at a comparable firm. Through the years of tender offers, They sell small amounts, enough to pay off student loans in 2017, make a down payment on a house in 2019, fund a family trip in 2022. The bulk of the position sits untouched. Those remaining shares, at the IPO price of $135, represent a life-changing sum. The median outcome for a senior employee who joined early and held through to this event is reported to be somewhere around $4 million. Not the top end, the median. There are people who walked onto the production floor in Hawthorne, California, making less than they would have at Boeing, who are now sitting on paper wealth that exceeds what their parents and siblings and friends have accumulated across entire careers. The company's president and COO, Gwynne Shotwell, employee number 11, on board since 2002, reportedly holds a stake worth over $1 billion. The CFO, similarly, is in the same territory. One of the early directors is reportedly looking at something in the range of $70 billion. That is not a misprint. The early investors, the employee story is remarkable. The early investor story is almost beyond comprehension. In 2008, SpaceX had failed its first 3 consecutive rocket launches. Elon Musk was personally financing the company with his remaining PayPal proceeds and privately acknowledging to close advisors that there might not be enough money for a 4th attempt. The 4th launch was described internally as existential. At that moment, with 3 consecutive failures, a nearly bankrupt balance sheet, and no commercial clients, a venture firm called Founders Fund, co-founded by Peter Thiel, invested $20 million. According to reporting on the firm's portfolio, Founders Fund's total gain on that investment has grown to approximately $19.5 billion. To put that in context, Founders Fund manages roughly $17 billion across its entire portfolio of investments. The gains on this single company exceed the size of the entire fund. The return on that 2008 check works out to approximately 62,000%. Alphabet, Google's parent company, invested $900 million in SpaceX in 2015, when the company's total valuation was approximately $12 billion. A 2026 regulatory filing revealed Alphabet's stake has grown to roughly 6% of the company. At a $1.75 trillion valuation, that 6% is worth approximately $100 billion. $900 million turned into $100 billion. Fidelity holds a significant position. Sequoia is in. Andreessen Horowitz led a funding round. The list of investors who are about to look prescient is long and involves some of the most recognized names in institutional finance. So when I say thousands of people are getting rich, that is a fairly literal description of the employee count, plus the fund managers, plus the early stage investors, plus the extended networks of all of the above. We are talking about one of the largest single wealth creation events in American financial history, concentrated in a relatively short window of time. How an IPO actually works, and who it's designed for. To understand how you can participate and why participation is harder than it looks, you need to understand the mechanics of the IPO process. A private company that decides to sell shares publicly files a registration statement with the SEC. This document, called an S-1, is the first time the company must disclose its finances, its risks, and its business model to the public. It is the company removing the privacy it has operated under since founding. The company then hires a syndicate of investment banks. In SpaceX's case, more than 20 banks, led by Goldman Sachs. Those banks conduct a roadshow, meetings with large institutional investors to gauge demand and establish an offering price. Then comes the allocation decision. Who gets shares at the IPO price, the $135, before the stock begins trading publicly? Historically, approximately 90% of IPO shares go to institutional investors. Hedge funds, pension funds, large mutual fund companies, sovereign wealth funds, and the top-tier clients of the banks running the deal. The remaining 10% is distributed among retail investors, ordinary individuals, and the competition for that 10% is intense. The reason institutions dominate is straightforward. They provide certainty. A pension fund that commits to $500 million of an offering is a reliable anchor, A retail investor submitting a $500 request is administrative overhead multiplied across millions of people. Here's why this matters to you specifically. On the first day of trading, IPO stocks frequently open at a significant premium to their offering price. Research tracking thousands of IPOs over decades documents an average first-day return of approximately 18%. Institutions that received shares at the offering price are often up double digits before noon on day one, purely for having been in the club. This is not an accident. It is the machine functioning as designed. SpaceX's 30% retail carve-out is genuinely unusual. It is approximately triple the typical retail allocation on a major offering. It represents a real change to the standard structure, but it does not illuminate the dynamics we just described. It modifies them. Keep that in mind as we discuss the four routes. What makes SpaceX worth $1.75 trillion? Before we get to whether you should participate and how, let's establish why the bull case for this company is genuinely compelling and why it isn't purely hype. The narrative around SpaceX tends to focus on rockets. Rockets are extraordinary, but rockets are lumpy revenue, expensive to build, and dependent on contracts. The rocket business alone does not explain a $1.75 trillion valuation. Starlink explains why SpaceX is worth $1.75 trillion. Starlink is SpaceX's satellite internet constellation. As of early 2026, it serves over 10 million subscribers across more than 155 countries, a subscriber base that doubled within a single year. Revenue from Starlink reached approximately $11.4 billion in 2025, up roughly 50% year over year. The adjusted EBITDA margin exceeds 60%. 60% margins on an internet service business that is now global in reach? The satellite hardware is largely a sunk cost. The rockets that deploy the satellites are built and operated by SpaceX itself, meaning the company is its own launch provider at a cost structure no competitor can match. To compete with Starlink, you need to deploy thousands of satellites. To deploy thousands of satellites affordably, you need cheap, reusable, high-frequency launch capability. The only organization on Earth with that capability at scale is SpaceX. Competitors must either launch with SpaceX, paying their primary rival, or wait years and spend tens of billions of dollars developing comparable launch infrastructure from scratch. That vertical integration is the actual moat, not patents, not brand loyalty. The physical inability of any competitor to replicate the cost structure without first solving the same problem SpaceX spent 20 years solving. The subscriber curve has not flattened. Every quarter, Starlink extends into markets that have never had reliable broadband: remote agricultural regions, maritime shipping routes, disaster zones, and military apps. Talking $99. The curve is not the one to suffer. There are customer categories for whom Starlink is not a choice between options. It is the only option. That pricing power is exceptional and durable. Beyond Starlink, Starship, the fully reusable heavy-lift rocket currently in advanced testing, if deployed at scale, would reduce the cost per kilogram to orbit by an order of magnitude. It would not just benefit SpaceX's commercial launch business, it would reset the economics of the entire space industry, with SpaceX collecting the majority of that value. There are substantial defense and government contracts. There is a militarized Starlink variant that the Pentagon is investing heavily in. There is an ongoing partnership with NASA for lunar missions. And then there is the long-term mission, the Mars architecture. Whether you find that inspiring or implausible, it is the reason this company exists and the reason Musk has structured it the way he has. The money raised in this IPO is not founders cashing out. It is capital for the most ambitious engineering project in human history. That is a genuinely unusual thing to be able to say about an IPO. The things that should give you pause. The bull case is real. The concerns are also real. Here is the honest version. At $1.75 trillion, SpaceX is priced at over 100 times its 2025 revenue, not earnings, revenue. The company recorded a net loss of approximately $5 billion on a GAAP basis, largely due to the integration of Musk's AI company and its associated cash burn. The combined entity carries an accumulated deficit exceeding $40 billion and recently took on a $20 billion bridge loan. Morningstar, one of the most respected independent investment research firms, ran their own valuation model and placed SpaceX's fair value at approximately $780 billion, less than half the IPO target. Their analysts described the company as significantly overvalued at the offering price and projected that investors would have opportunities to buy shares at lower prices after the initial frenzy settles. There is also the governance structure. Musk retains approximately 85% of voting power through a dual-class share structure, despite owning closer to 40% of the economic interest. SpaceX is going public as what is legally classified as a controlled company, which exempts it from certain normal corporate governance requirements. When you buy SPCX, you are buying a share of the economics, the profits and growth, but almost no meaningful voice in how the company is run. For some investors, this is acceptable. For others, it is disqualifying. It is worth knowing clearly before you decide. Musk's own compensation structure deserves a sentence of its own. Portions of his equity vest only upon the company achieving a $7.5 trillion market cap and establishing a permanent human colony on Mars. Most executive compensation packages require hitting revenue targets. This one requires colonizing another planet. The 4 ways to participate now. The part you came for. Route 1. Request shares at the IPO price. SpaceX has made the retail allocation available through a handful of mainstream brokerages: Charles Schwab, Fidelity, Robinhood, SoFi, and Trade. If you hold an account at any of these platforms, you can submit what's called an indication of interest during the offering window, a request to receive shares at $135 before trading begins. This is as close to insider access as retail investing has ever gotten on a deal of this size. The catch is arithmetic. Demand for this offering will be extreme. Even 30% of a $75 billion deal distributed across the full retail investing population of the United States is a thin slice per person. Someone requesting $2,000 worth may receive $200, or $50, or nothing. Schwab historically has required substantial account balances to participate in IPO allocations. Robinhood has penalty rule or selling allocated IPO shares quickly, which affects future access. Worth trying if you have access. Not worth building your entire plan around because the realistic allocation for most people will be a small fraction of what they requested. Route 2. Buy on the open market after trading begins. Once SPCX begins trading, any brokerage account on Earth can purchase shares. No minimum balance, no allocation lottery, no eligibility requirement. You want one share, you buy one share. You want fractional shares worth $50. Most major brokerages now support that. The catch here is price. The open market on day one will reflect the maximum enthusiasm of millions of buyers simultaneously. Based on historical IPO data, that price is frequently elevated relative to where the stock trades weeks or months later. The most excited buyers set the opening price. Patient buyers find better entries after the excitement fades. Buying on the open market is the most accessible route. Accessible does not mean optimal. Route 3. The pre-IPO secondary market. For years before the IPO, platforms like Forge Global, EquityZen, and Hive facilitated transactions where SpaceX employees and early investors sold portions of their holdings to outside buyers. In early 2026, shares on these platforms were trading at $600 to $750 each. This route is legally restricted to what the SEC classifies as accredited investors, individuals earning over $200,000 annually or $300,000 as a couple for at least 2 consecutive years, or with a net worth exceeding $1 million excluding their primary residence, or holding certain professional financial licenses. Those thresholds were established in 1982 and have never been adjusted for inflation. Approximately 18% of American households currently qualify, up from under 2% in the 1980s. If you are not in that 18%, this route is legally closed. If you do qualify, be aware that pricing on these secondary platforms is opaque and inconsistent. The same underlying shares traded at different prices simultaneously on different platforms during 2026. SpaceX also retains certain rights to cancel secondary market transactions under specified conditions. The due diligence burden is substantially higher than buying a public stock. Route 4. Public market funds with SpaceX exposure. This is the route almost nobody is covering, clearly, and it is the one most accessible to the broadest range of people. Several publicly traded funds and companies hold significant SpaceX positions right now, today, before the IPO. Buying them requires nothing more than a standard brokerage account, no minimum balance, no accreditation test, no allocation lottery. Alphabet, Google's parent company, holds approximately 5 to 6% of SpaceX, worth roughly $100 billion at the IPO valuation. Buying Alphabet stock gives you SpaceX exposure wrapped inside one of the most profitable businesses in the world, at no speculative premium. This is the least glamorous option, and arguably the most rational one. ARK Venture Fund, a fund managed by Cathie Wood's ARK Invest, where SpaceX is the single largest holding at approximately 17% of total assets. The catch: this is an interval fund, meaning you can purchase shares but can only redeem them during specific quarterly windows. You cannot sell on any given day. It also carries a management fee approaching 3% annually, which is high. Barron Partners Fund, a mutual fund where SpaceX represents a substantial portion, close to 30% of total holdings. More liquid than the ARK vehicle, accessible through standard brokerage platforms. One important warning: a closed-end fund called Destiny Tech 100, ticker DXYZ, holds SpaceX as its largest position and has been heavily discussed in retail investing communities. At the end of 2025, its net asset value, the actual calculated worth of its holdings, was approximately $20 per share. The market price was approximately $60 per share. That means people were paying $60 for $20 of actual assets. A 200% premium above the real value of the underlying holdings is not a bonus. It is a tax you pay for enthusiasm. Premiums of that magnitude have historically collapsed back toward fair value once excitement fades. Buying DXYZ for SpaceX exposure means paying triple for the same asset available at no markup through Alphabet. Know exactly what you are buying before you buy it. How to think about this without getting wrecked. Here is the part of this conversation that the people selling you SpaceX excitement in comment sections and on social media absolutely do not want you to hear. The investors most likely to lose money on this IPO are not the skeptics. They are the enthusiasts, the people who will buy at any price on day one because they love the company so much that the distinction between loving a company and making money on its stock has blurred entirely. Those are different skills. Confusing them is one of the most expensive mistakes you can make in investing. So here is a rational framework for approaching this. You do not have to do anything in the next 4 days. The loudest voice in your head right now is probably telling you that missing day one means missing it forever. That voice is historically wrong and financially expensive. Major IPOs routinely offer better entry points in the weeks and months following their debut than on the opening morning. Morningstar explicitly projects that patient investors will find lower prices after the initial enthusiasm fades. The lockup expiration, when insiders become free to sell large quantities of stock, likely around December, frequently creates price pressure that benefits buyers who waited. The urgency you feel is real. The information driving it is not. If you want to participate, size it appropriately. A common and sensible guideline: no more than 1 to 2% of your total portfolio in any single IPO, and speculative positions of this kind combined should represent no more than 5% of your total invested assets. This is money you have genuinely decided you can afford to lose entirely, not rent money, not an emergency fund, not a down payment. At 1 to 2% of a portfolio, a position that triples is a genuinely excellent year. A position that loses 80%, a range that has happened to beloved, legitimately great companies after IPO frenzies, is disappointing but survivable. The asymmetry of small bet, meaningful upside, survivable downside is the framework that separates disciplined investors from people making headlines about how they lost their savings on a rocket company. If timing feels impossible, remove the decision. Dollar cost averaging, split in a predetermined amount into several purchases over time, rather than committing everything at once, is not exciting. It reliably prevents you from putting everything in at the exact top. Buying a portion now, a portion after the first earnings report this fall, and a portion around the December lockup expiration means you will never nail the perfect entry price. But you will also never be the person who put everything in on the first morning at the peak of enthusiasm. The person who watches the chart at midnight trying to catch the exact bottom almost never catches it. The person who buys the same amount every quarter for 3 years captures the average, and the average across a genuine long-term winner is usually very good. Watch for fraud. An event of this scale and visibility is a magnet for con artists. The moment SpaceX becomes the dominant story in financial media, your inboxes and comment sections will fill with people offering exclusive pre-IPO shares, tokenized instruments that supposedly track SpaceX, and private deals with undisclosed markups built in. Real access to this IPO goes through registered, reputable brokerage platforms. The name of the brokerage matters. If someone contacts you unsolicited with a SpaceX opportunity, the answer is no. Fear of missing out is the single easiest emotion to exploit financially, and this event is generating it at scale. The bigger picture. Let's come back to where we started. 13,000 people inside a building in Hawthorne, California are about to have their lives transformed. Engineers who took lower salaries for equity. A president who has been there since 2002. Early investors who wrote checks into something that looked like it might be a spectacular failure. Venture firms that made bets the rest of the financial world called reckless. They got rich because they found a way inside the room and held on for a long time. For most of your investing life, the door to events like this has been functionally sealed for people without institutional access or accredited investor status. You watched from outside while the people inside got rich, and your only available move was to buy years later after most of the appreciation had already happened. What is genuinely different this time is that the door is measurably more open than it has ever been on a deal of this size. 30% reserved for retail, 5 mainstream brokerages with accessible interfaces, publicly traded funds holding SpaceX positions available for under $100. The infrastructure to participate exists in ways it did not 5 years ago. The catch, and there is always a catch, is that the door being open and you being equipped to walk through it wisely are not the same thing. Walking through it wisely means understanding the price relative to the fundamentals, knowing what you're actually buying, sizing the position in proportion to the risk, and resisting the narrative that day one is the only day that matters. The opportunity is real. The hype is also real. Telling them apart is the skill. And now you have enough information to do that. Now you know.